Hi, I'm Burt White, Chief Investment Officer of LPL Financial, and I'm excited to share with you LPL Research's Mid-Year Outlook, a shift in market control. Make no doubt about it, a long overdue and highly anticipated shift is underway that may change the character of the rest of this economic cycle. Specifically, the Federal Reserve has finally been able to follow through on its projected path of rate hikes. This shift highlights two important signals. First, more and more the Fed trusts that the economy has largely met its dual mandate of 2% inflation and full employment. And second, and perhaps even greater importance, there may finally be the new driver for markets and the economy, the long-awaited arrival of fiscal policy. Going forward, fiscal policy may provide the economic backstop that monetary policy has offered throughout this economic expansion. Within this new dynamic, we are watching several key themes to see how the change in market leadership may impact 2017 and beyond. Now let's first start with monetary policy. The Fed has been slowly powering down support since it started tapering its bond buying in January of 2014. We believe the gradual approach to rate hikes will continue and look for a total of 2 or 3 rate hikes in 2017. We also expect a measured increase in inflation throughout year-end as labor markets continue to improve steadily and oil price gains flow through, providing even greater ammunition for the Fed to continue its efforts to normalize interest rates. As investors increasingly trust that the economy can stand on its own without the need of monetary policy support, business fundamentals should take over as the primary market engine, and corporate profits will take on increasing importance. We have raised our 2017 S&P 500 index total return forecast slightly to 6 to 9%, driven by 4 key areas. 1, a pickup in U.S. economic growth. 2, mid to high single-digit earnings gains. 3, a stable price-to-earnings ratio of between 19 and 20. And 4, prospects for a fiscal policy boost to earnings in 2018. Progress on fiscal policy as the next potential economic driver is the real wild card. Even though overall confidence has risen since the election, businesses and consumers haven't yet provided a significant boost to the economy. This is likely due to uncertainty about the direction and potential impact of the Trump administration's fiscal policy agenda. While implementation of pro-growth policies such as tax reform, infrastructure spending, and deregulation remains likely, the timetable may very well be pushed back. Despite potential delays in fiscal policy as a potential economic growth power source, we continue to look for the U.S. economy to expand at near 2.5% GDP growth in 2017, driven by advances in consumer spending, housing, manufacturing, and perhaps most important, business investment. Now looking overseas, economic growth has been gradually improving in Europe and Japan. Monetary policy has fueled economic and financial market gains, yet economic reforms are still needed to address some structural challenges. We remain cautious on developed international markets, but more hopeful on opportunities within emerging markets based on attractive valuations and growth characteristics. Turning to the bond market, we expect a limited return environment to continue. The 10-year Treasury yield may end 2017 in the 2.25 to 2.75 range, with the potential for moves towards 3% should anticipated policy support lead to meaningful rise in economic activity. Divergent global central bank activities, moderate inflation pressures, and attractive valuations for U.S. Treasuries relative to global alternatives may support bonds at higher yields. With all of this in mind, let's discuss our investment recommendations. For bonds, we anticipate a gradual rising rate environment and accordingly support slightly below benchmark duration to help manage interest rate risk. For high-quality fixed income exposure, we favor investment-grade corporate bonds, along with mortgage-backed securities, given their attractive yield per unit of duration. Additionally, despite full valuations, bank loans may benefit from gradually upward trending short-term interest rates. In terms of equity positioning, we favor U.S. over developed foreign due to currency risk and European political uncertainty. And we see potential opportunity in emerging markets based on strong earnings gains and attractive valuations. On a sector basis, technology may be positioned to benefit from the continued solid earnings growth as business investment potentially picks up and drives higher productivity. Industrials may benefit from possible spending on defense and infrastructure projects and stronger global demand. Financials should benefit from deregulation that may free up capital for lending and dividends, while tighter monetary policy may drive profitability. All in all, if we have shifted to new market dynamics, including a greater role for corporate profits, understanding the evolving opportunities will be important for diversified investors. As monetary policy powers down, business fundamentals power up, and fiscal policy helps get the U.S. economy off of standby mode. We encourage you to leverage LPL Research's Midyear Outlook and consult with your financial advisor as you seek to make progress towards your long-term financial goals. Thank you for listening.